The global financial landscape is undergoing a seismic shift characterized by unprecedented economic policies, rising inflation, geopolitical uncertainties, and fluctuating investor sentiment. While stock markets have enjoyed an extended period of growth over the past decade, largely fueled by low interest rates and expansive monetary policies, the winds are changing. Investors who have focused solely on equities may find themselves exposed as traditional asset classes face new risks. In this evolving scenario, the allure of gold and silver as reliable hedges against inflation and economic instability is making a strong comeback. This comprehensive analysis delves into the historical context, current economic dynamics, technical trends, and investment strategies related to gold and silver, aiming to provide a holistic understanding of why these precious metals may be entering a new significant bull market phase. To understand the potential future trajectory of gold and silver, it is crucial to reflect on their historical performance during past economic upheavals. Gold, often referred to as the ultimate safe haven asset, has a history that stretches back thousands of years as a store of value. From ancient civilizations using gold coins to modern central banks holding vast reserves, gold's role as a trusted medium of exchange has remained largely unchallenged. Silver, known as the poor man's gold, has similarly played a significant role, especially as an industrial and monetary metal. Looking back at the 20th century, the Great Depression of 1929 serves as an early example of how gold provided a safe haven during economic collapse. As stock markets plummeted and deflation gripped the global economy, the price of gold held steady, bolstered by the U.S. government's fixed gold standard policy. Decades later, the 1970s saw a similar story during a period of stagflation, high inflation coupled with stagnant economic growth. The removal of the gold standard in 1971 by President Richard Nixon marked a turning point, allowing gold prices to float freely. This led to a spectacular rally, with gold prices increasing nearly tenfold by the end of the decade, driven by runaway inflation, geopolitical tensions, and a loss of confidence in the U.S. dollar. The late 1990s and early 2000s marked another significant period for precious metals. Gold began a prolonged bull market in 1999, rising from a low of around $250 per ounce to a peak of nearly $1,920 in September 2011. This rally was fueled by a combination of factors, including the bursting of the dot-com bubble, the 2008 financial crisis, and aggressive monetary easing by central banks worldwide. Silver, too, experienced a dramatic rise during this period, moving from below $5 per ounce in the early 2000s to almost $50 per ounce in 2011. Investors flocked to precious metals as safe haven assets amid fears of inflation, currency devaluation, and systemic financial risks. Fast forward to the present day, and we find ourselves at the crossroads of multiple macroeconomic factors that once again favor a bullish outlook for gold and silver. The unprecedented monetary expansion undertaken by central banks in response to the COVID-19 pandemic has fundamentally altered the financial landscape. The Federal Reserve, the European Central Bank, ECB, and other major central banks have injected trillions of dollars into the global economy through quantitative easing (QE) programs aimed at stimulating growth and preventing a deeper recession. While these measures provided short-term relief, they have also sown the seeds of long-term inflationary pressures. Inflation, which had remained subdued for much of the past decade, began to surge in 2021 and 2022, reaching levels not seen in over 40 years. The U.S. Consumer Price Index, CPI, soared, driven by rising energy prices, supply chain disruptions, and increased consumer demand. Central banks initially dismissed this inflation as transitory, but it has proven to be more persistent and broad-based than expected. As a result, the Federal Reserve has been forced to pivot from its accommodative stance to a more hawkish approach, raising interest rates at a rapid pace in an attempt to tame inflation. This shift in monetary policy has created a challenging environment for traditional assets, like stocks and bonds. Rising interest rates increase borrowing costs for corporations and consumers alike, putting downward pressure on corporate profits and leading to a repricing of equities. Bonds, which had benefited from decades of declining interest rates, are also facing headwinds as yields rise. In contrast, gold and silver historically perform well during periods of high inflation and economic uncertainty, as they are viewed as reliable stores of value that retain purchasing power. From a technical analysis perspective, both gold and silver have shown signs of renewed strength. Gold has recently broken through key resistance levels, hovering around the $2,000 per ounce mark. This price level is significant because it has acted as a psychological barrier in the past. A decisive break above $2,100 per ounce would signal a major technical breakout, potentially triggering a wave of buying as traders and investors look to capitalize on the upward momentum. Silver, often more volatile than gold due to its dual role as an industrial and monetary metal, is also showing bullish signals. The $30 per ounce level is a critical resistance point for silver, and a sustained move above this level could lead to accelerated gains, similar to the price surge seen in 2010-2011. Market sentiment also plays a crucial role in shaping the price dynamics of precious metals. The current sentiment towards gold and silver is increasingly positive, as evidenced by rising inflows into gold and silver exchange-traded funds, ETFs, and increased demand for physical bullion. Central banks, particularly those in emerging markets, have also been adding to their gold reserves at a record pace. This trend reflects a growing desire among nations to diversify away from the U.S. dollar amid concerns over dollar depreciation and the long-term fiscal health of the United States. The global financial system today is facing unprecedented levels of uncertainty. Our monetary structure, primarily driven by central banks and fiat currencies, is built on a delicate balance of trust and control. This delicate balance is currently under strain as the weight of massive global debt, over $93 trillion, pushes against the limited supply of currency. As the world navigates complex financial landscapes, it becomes evident that if the public loses confidence in the banking system or the currency itself, everything could collapse. The introduction of central bank digital currencies, CBCs, could potentially trap citizens within a system controlled by financial institutions with unparalleled authority. If such a system is fully realized, it could lead to the implementation of negative interest rates, deepening the crisis as governments borrow more to pay ever-growing interest on their debts. A real and present danger exists as currencies created through loans vanish when repaid, creating an imbalance that is unsustainable. In contrast, assets like gold, long considered a safe haven, have become increasingly vital as central banks build their reserves in anticipation of a potential monetary shift. This growing trend signals that a major financial transition could be on the horizon, one that could reshape the entire global economic system. The core of this financial instability lies in the unsustainable relationship between debt and currency creation. Central banks around the world create currency by extending loans, yet the money created vanishes as loans are repaid. This cyclical process of creating and extinguishing money leads to a system that operates on the premise of perpetual debt, with $93 trillion in global obligations and a mere fraction of that in currency to cover it. The imbalance is glaring, yet the financial system has been able to function under these conditions, largely because fiat money is not backed by any tangible value or physical asset. It is based entirely on trust, and as long as confidence in the system remains intact, it persists. However, when that trust begins to wane, as it inevitably will, considering the fragility of the banking system, the entire structure is at risk of collapse. The growing reliance on debt-fueled currency creation, coupled with a lack of any tangible backing, creates a dangerous environment where systemic failure is not just possible, but inevitable. In the midst of this instability, gold and silver stand as enduring stores of value. Unlike fiat currency, which is subject to the whims of central banks and governments, precious metals like gold have a long history of maintaining value across centuries. Central banks around the world are increasing their gold reserves, signaling that they understand the limitations of fiat currency and the coming challenges. Gold is seen as a hedge against inflation and economic collapse, and its importance only grows as the global financial system faces increasing pressure. Countries like China, the world's largest producer and importer of gold, are positioning themselves strategically for a future where gold once again becomes the cornerstone of a stable monetary system. This shift towards gold may not happen overnight, but the signs are clear that central banks are preparing for a new financial order where gold, and by extension, silver, are central to economic stability. For investors, this means that gold and silver are not just commodities. They are crucial components of wealth preservation in a world increasingly marked by financial turmoil. The expansion of the money supply through quantitative easing (QE) has been a major driver of inflation and asset bubbles. QE is a policy employed by central banks to inject liquidity into the economy by purchasing financial assets, primarily government bonds. This policy, while designed to stimulate growth during periods of recession, has had the unintended consequence of inflating asset prices, particularly in real estate, stocks, and bonds. The long-term effect of this artificial expansion of the currency supply is the creation of financial bubbles, which, when they burst, can trigger widespread economic instability. The low interest rates that have accompanied QE policies have further fueled the inflation of these bubbles, making them increasingly fragile. As central banks raise interest rates in an attempt to curb inflation, the potential for these bubbles to burst increases. This tightening of monetary policy, while necessary to control inflation, could also trigger a massive contraction in asset prices, leading to financial crises and significant economic downturns. The consequences of these policies are felt across the global economy, where stock markets and real estate have become increasingly disconnected from the underlying value of assets. The global financial system is more interconnected than ever before. In the past, recessions would unfold over time, with countries experiencing downturns in succession through trade linkages. Today, the system is linked through a complex web of derivatives and financial instruments, allowing crises to spread almost instantaneously across borders. A downturn in one part of the world quickly reverberates throughout the entire system, as evidenced by the 2008 financial crisis. Bank failures, once rare, have become more common as financial institutions become increasingly leveraged, creating massive risks within the banking system. Senator John Kennedy's assertion that the banking system is essentially a Ponzi scheme underscores the fragility of modern banking systems, where trust in the institution is all that holds them together. As more people become aware of these risks, the potential for bank runs increases, with customers rushing to withdraw their funds before the system collapses. The public's increasing awareness of the fragility of the banking system is a significant threat to the stability of the global economy. The potential for widespread panic is real, and once that panic sets in, the system may not be able to recover. Inflation and interest rates are inextricably linked, and their manipulation by central banks has profound effects on wealth creation and preservation. When central banks lower interest rates, they make borrowing cheaper, which stimulates economic activity and boosts asset prices. However, this also increases the money supply, leading to inflation and a devaluation of currency. As inflation rises, the purchasing power of money decreases, eroding the wealth of individuals who hold cash. Conversely, when central banks raise interest rates to combat inflation, they slow down economic activity, making borrowing more expensive and cooling off asset prices. The delicate balance between inflation and interest rates is one of the primary tools used by central banks to manage the economy. However, these tools are not always effective, and their long-term impact can be unpredictable. As inflation continues to rise, it becomes increasingly difficult for individuals to preserve their wealth, especially if they are holding assets in cash or bond. In this environment, gold and silver shine as stores of value, retaining their purchasing power, while fiat currencies lose theirs. Given the current state of the global economy, predictions for the prices of gold and silver are increasingly bullish. As central banks continue to print money and inflate asset bubbles, the value of fiat currencies is expected to decline, driving investors towards precious metals. In times of economic crisis, gold and silver tend to perform well, as they are seen as safe haven assets. The demand for gold is expected to rise as countries like China and Russia continue to build their reserves, while central banks around the world are increasingly turning to gold as a reliable store of value. Silver, often seen as a more affordable alternative to gold, is also expected to see significant gains as investors seek a hedge against inflation and currency devaluation. In the short term, gold and silver prices may experience some volatility, but over the long term, the outlook remains strong as the global financial system continues to show signs of instability. In the face of growing economic instability, individuals must take steps to protect their wealth. The first step is to diversify assets, ensuring that a portion of wealth is allocated to physical assets like gold and silver, which can act as a hedge against inflation and currency devaluation. Real estate and stocks, while valuable, are vulnerable to the same systemic risks that threaten the broader financial system. Holding physical precious metals in a safe location can provide a level of security that financial assets cannot. Additionally, reducing reliance on debt and being prepared for potential interest rate hikes can help protect financial security during times of crisis. Risk management strategies, such as maintaining liquidity and reducing exposure to speculative assets, will also be essential for navigating the coming economic challenges. In times of financial turmoil, those who are prepared are more likely to weather the storm and emerge stronger on the other side. As confidence in traditional banking systems wanes, central banks are exploring alternatives like central bank digital currencies, CBDCs, to maintain control over the monetary system. Unlike decentralized cryptocurrencies, such as Bitcoin, CBDCs are centralized digital currencies controlled by governments and central banks. These digital currencies offer the potential for greater control over the economy, allowing for real-time tracking of transactions and direct influence over interest rates and monetary policy. While the introduction of CBDCs could streamline financial systems, it also poses significant risks to personal freedom and financial privacy. In a world where digital currencies are the norm, the government could have unprecedented access to individuals' financial transactions, potentially leading to a system of financial surveillance. The implementation of CBDCs could also pave the way for the introduction of negative interest rates, where individuals are charged to hold money, further exacerbating the current debt crisis. While CBDCs may offer temporary stability, they also represent a significant step towards centralized control over the global economy, raising questions about the future of financial autonomy. As we stand on the precipice of a potential global financial collapse, it is essential to understand the forces at play and take proactive steps to protect wealth. The current monetary system, based on debt and fiat currency, is unsustainable and vulnerable to systemic failure. Gold and silver, once again, are emerging as the cornerstone of financial security, offering a stable store of value in uncertain times. The future of the global economy depends on the ability of governments and central banks to manage their monetary policies effectively, but with inflation, rising debt, and the erosion of trust in the banking system, the outlook is uncertain. By diversifying assets, investing in gold and silver, and being prepared for economic uncertainty, individuals can protect their wealth and navigate the challenges ahead. The time to act is now, before the next financial crisis hits.